The broadcast is now starting. All attendees are in listen-only mode.
Hello everyone, thank you for joining us today. I'm Mike Zedek, I'm the Managing Director of Retail Trading at Lightspeed. And today we're pleased to bring you this live webinar on the rules of engagement for leveraged and inverse ETFs. Leveraged ETFs have proven themselves as a very effective trading vehicle for some of Lightspeed's most profitable clients. And this is people ranging anywhere from intraday traders to longer-term hedgers. With us today, I'm very happy to have Jordan Ferris, who's the Vice President of Business Development at Direxion Shares. And if you're not familiar with Direxion, they are a pioneer in providing multi-directional and leveraged products which offer the opportunity for investors to effectively manage risk and returns in multiple market conditions. Toward the end of the webinar, we're going to do a Q&A session. So throughout the webinar, if any questions come up, please feel free to type them into the webinar message box. Or if you want, just hold them until the end and type them in then. Also, this webinar will be recorded and will be posted on lightspeed.com within the next few days, so you can always come back and view it at a later date. So now I'll turn the presentation over to Jordan, who's going to show us how traders and investors can effectively incorporate these leverage and inverse ETFs into their trading strategies. Jordan?
Thanks, Mike. And good afternoon, everyone. Thanks for joining us today. Again, as Mike said, my name is Jordan Ferris, and I'm Vice President of Business Development at Direction Shares. It's certainly a pleasure to be here. I want to thank Lightspeed and Mike for inviting us to speak a little bit today about leveraged and inverse ETFs. As many of you may know, leveraged and inverse ETFs have been one of the more controversial topics or types of securities over the past few years. We here at Direxion have heard just about every accusation under the sun when it comes to these products. We do understand that they're certainly not for everyone. They're definitely more risky than traditional 1-beta ETFs, but they are powerful tools, and they do exactly what they're designed to do, and they do that very well. So that being said, education and understanding what it is these products are designed to do is extremely important. Part of my role at Direxion and all of my counterparts in the business development team, our role is education. We spend about 90% of our time doing this. And hopefully that's something that we can accomplish today with you all. My goal is to arm you with some knowledge and some understanding of the intricacies of these products, so you can take that and go decide if these products make sense for you as a fit in your own investment objective. So, as Mike said, we're going to save some time for questions at the end. If you do have any, feel free to type them into that chat box. The more the better. We always like taking questions. So, just to expand a little bit on the brief history of Direxion, Direxion's been managing leveraged mutual funds since 1997. In late 2008, we decided to launch the industry's first 3x and negative 3x ETFs. We've quickly ramped up in that space to about $6.5 billion in assets over 42 different products, and we're going to see examples of a few of those products as we go through the presentation today. So quickly to get started, we've got some disclosures, as most firms do up front. I'm going to go through those right to a quick little pop quiz. Just 5 short questions to kind of test your own understanding of how the leverage products work. We're obviously not going to be grading anybody on this, but in your own mind, just take a guess at what the answer would be, and then we'll go through the answers. So, first question: if you invest $5,000 immediately after the market opens in an ETF that seeks 300% return of its benchmark index, you will A, obtain $15,000 worth of exposure and have $15,000 worth of market risk. B, obtain $15,000 worth of exposure and have $5,000 worth of market risk. C, obtain $10,000 worth of exposure and have $10,000 worth of market risk. D, obtain $5,000 worth of exposure and have $5,000 worth of market risk. Or E, none of the above. And I'll give everybody just a couple seconds to think about that. So here the answer is going to be A. If you invest $5,000 right after the market open, you're going to have $15,000 worth of exposure and $15,000 worth of market risk. One key point we want to make here with leveraged and inverse ETFs is that they're a little bit different than margin accounts. With a margin account, you can actually lose more than your investment. With a leveraged or an inverse ETF, you can't lose more than your investment. So in this particular example, you're not going to lose more than $5,000. Second question, if you invest in an ETF that seeks negative 200% return of the underlying benchmark index, and that index moves 5%, what will your expected return be for that day? A, 15%, B, negative 5%, C, negative 10%, D, greater than 10%, or E, I don't know. E is a perfectly reasonable answer. These are difficult questions. The answer to this is going to be C, negative 10%. And that's a simple mathematical equation. If you have a 2x fund, that's a negative 2x fund, and the index goes up 5% in that first day, negative 2 times 5, you're going to be down 10% for that particular day in that fund. On to the third question in the pop quiz. This is going to be probably the most difficult one. If you get this right, you're doing well, and I think you'll benefit from this. An investor purchases a daily leveraged ETF that seeks 300% return of its benchmark index and holds it for 5 days. That benchmark index has increased by 5% during that period. What will be that investor's expected return on investment for the full period? Will it be A, greater than 15%, B, less than 15%, C, exactly 15%, or D, not enough information to determine the return? The answer to this one's going to be D, not enough information to determine the return. And this is where people start to get tripped up with leveraged and inverse ETFs. You're thinking in your head, all right, 5%, I've got a 3x fund, the index went up 5% during that period, the return should be 15%. And that actually isn't the case. These products, because they're leveraged on a daily basis, are very path dependent. The objective of the funds is to provide a multiple of the return only on a daily basis. So if you end up holding it for a longer time period, those daily returns can compound, and you can end up with a very different return than simply 2 or 3 times whatever the index did. And we're going to talk about this in some of the slides that are coming up. The key point here is the path the index takes over the holding period is going to greatly affect your returns. And this is probably the most misunderstood aspect of leveraged and inverse ETFs. It's called daily compounding, and we're going to spend a lot of time on it later in the presentation. So the fourth question, the FINRA margin requirement for a 2x bear leveraged ETF is A, greater than a 2x bull ETF, B, less than a 2x bull ETF, C, exactly the same. I'll give you a hint, it's not D on this one, it's A, B, or C. The answer for this is A. It's actually greater than a 2x bull ETF. Bear funds do have larger margin requirements than bull funds. Back in 2009, FINRA increased the margin requirements for bull funds from 25% to 25% times the beta of that fund. So a 2x long fund now has a margin requirement of 50%. Bear funds had margin requirements of 30%. They're now 30% times the beta. As an example here, a 3x short fund originally had margin of 30%, now has margin of 90%, or margin requirements of 90%. Final question. A daily leveraged ETF that seeks 200% return of its benchmark index had a closing NAV yesterday of $10. Today, that same fund has an indicative NAV of $10, but the investor purchases it at a discount. They purchase it at $9.75. How much exposure has this investor purchased? A, greater than 200%, B, less than 200%, C, exactly 200%, or D, there's no way to know how much exposure the investor will receive. Here the answer is A, greater than 200%. And the way to think about this is ETFs trade on an exchange. They're subject to the laws of supply and demand, and at times they can trade away from their fair value. Typically, we're going to have arbitrageurs that are going to pick up on these price dislocations and snap them back into line, but they do sometimes trade at premiums and discounts. In this specific example, you're buying at a discount to the NAV, so you actually have slightly more exposure or slightly more leverage than 2 times. And we're going to talk about all these things as we get through the presentation. So hopefully that gave you an indicator for your own personal understanding of the products and how they work. Don't worry if you got a few of them wrong. We're going to run through all the basics here, and hopefully you all be pros by the time we get done with the presentation and the question and answer session at the end. So this slide's going to kind of set up the framework for the rest of the presentation, what we really want to drive home is that leveraged ETFs are very different than standard ETFs. As I talked about a little bit before, they have daily investment objectives, and therefore they're designed more as trading tools for traders like yourselves, as opposed to investing tools which are more suited towards the buy and hold investors. We're going to talk a little bit about leverage, what's actually inside a leveraged ETF, how do we get the leverage, and how does that affect return. We're going to talk about compounding, when it works for you, when it doesn't work for you, and then I'll give some examples of how these products are used by different types of clients and how they've been used over the past year. So with that, let's move into leverage and the basics of leverage and how we achieve the leverage inside our products. I'm going to start with the bull products. Our bull funds are a combination of an equity basket, or the underlying equities in the index, and derivatives, either swaps or futures contracts. At Direxion, we use total return swaps to get our additional exposure. We have bull funds that have 300% exposure to an index. We usually hold anywhere between 10 and 80% of that exposure in the actual equities, and the rest is achieved via a total return swap, the 220 to 290%. That's achieved via the total return swap. Derivatives sort of have a bad name these days, especially swaps, but when they're used properly, they can be very effective tools at mitigating risk. The type of swaps we use also, just to clarify, are a little bit different than the ones that got a bad name during the credit crisis, which were credit default swaps. What we use are total return swaps. They're very transparent. They're very plain vanilla. They're swaps on an index that is very easy to price. It's very transparent. You can see what's inside that index, different from the swaps that got the bad name during the credit crisis. The swap is simply a contract between ourselves and a number of counterparties, which are banks. The counterparty uses their balance sheet to extend to us the leverage that we need for the product, and in return we pay a financing fee for this leverage, which is baked into the management fee of the fund. Our bear funds are based entirely on swaps, so all 300% of the exposure is in the total return swap. With the swap, we're guaranteed a market on close, so the bear funds track extremely well because they're all based on this swap. The bull funds, they do have a little bit in equities, as I said, 10 to 80% of the total 300%, so you might see a little bit more slippage in the bull funds, but they do also track extremely well. So moving on, the next 4 slides, I'm going to give an overview of daily investment objectives and how we manage the funds on a daily basis, so from the perspective of our trading desk, and then the next slide will be from your perspective. We're going to look at a bull fund when the underlying index rises, as well as when the underlying index declines. So if we look at step 1 in this example, this is what the fund looks like at the beginning of the day. We have $100 in assets. We have $300 worth of exposure to that index to make sure that we're going to have a 3x or a 3 beta return for that day. If we move over to step 2, we see that the index has moved up 1% that day. Since we're levered up 3 times, we have a 3% return in the fund, a $3 gain, which means tomorrow we're going to have $103 to start the day with. In order to ensure that we go out tomorrow with a 3 beta again, the 3 times exposure, we need to adjust our total amount of exposure. As you can see in step 2, we have a total of $303 worth of total exposure at the end of the day. But what we really need is 3 times our asset level. If we look at this, 3 times 103 is 309. So that at the end of the day, our portfolio managers are looking at this and they say we need to go out and lever up a little bit more, $6 worth of additional exposure. So we go out and adjust our swap. We buy $6 worth of exposure to this index, so we have $309 worth of exposure with $103 worth of assets. Now, what does this look like to the investors, to you all? So at the beginning of the day, if you have $10,000 and you invest that in a leveraged ETF, you now have $30,000 worth of market exposure and $30,000 worth of market risk. If the index goes up 5% that day, you did great, nice trade, awesome. You made 15% on your $10,000 investment or a $1,500 gain. If you hold that investment into the next day, your $11,500 is going to have 3 times exposure for that next day. So you can start to see how each daily return can compound when it's held for multiple day holding periods. And we're going to talk about this in the next section, and you can see when this can work for you in terms of compounding and when compounding can work against you. Here we have a very similar example, except the index is going to decline. So again, you start the day with $100 in assets in the fund, or our portfolio managers are looking at this. They have $300 worth of exposure. The index drops 1%, meaning the fund's going to lose 3%, giving us $97 in assets in the fund. 3 times $97 is $291. So that's the exposure we need going into the next day. But if you look at step 2 there, we have $297 worth of exposure. So we need to reduce our total exposure at the end of the day to make sure that we get that down to $291 to make sure we give you that 3 beta for the following day. And again, from your perspective, if you invest $10,000 in a 3 beta fund, you have $30,000 worth of exposure as well as $30,000 worth of market risk. If the fund drops, or if there's an index move of 5%, you're going to be down 15% or $1,500. If you hold the position, your $8,500 will again have 3 times exposure going into the following day. But it's good to keep in mind that in order to get back to that $10,000 initial position, the fund's going to have to make more than 15%. So that's one of those compounding examples that we're going to talk about here coming up. So the next 3 slides, I'm going to give examples of compounding in 3 different market environments: trending up, trending down, as well as a choppy and volatile market but going sideways. So for this first example, this is trending up. Daily compounding tends to be one of the most misunderstood parts about a leveraged ETF. So I think these next 3 slides are particularly important to pay attention to. In this example, we see an index going from 100 to 108. So it's an 8% gain over a 4-day period. And if you're in a 3x bull fund, you may expect a 24% return over that time period, 3 times 80 being 24. But if you look over at the right-hand side of the screen, you can see that the cumulative return of this fund over this period of time was 25.43%. It's a little bit more because we keep expanding our exposure. We keep growing our exposure over this period of time, and the returns are based on that new exposure level. So you actually end up doing a little bit better because of the compounding in this situation. Similarly, in a declining market, even if it's trending, compounding will also work for you. So if we start at 100, we go down to 92 over a 4-day period. That's a cumulative return of negative 8%. If you're in a 3x bull fund, you may expect to get negative 24% in terms of return over that period. But if you scroll over to the right again, you see it's negative 22.55%. And this is because we've been lowering our exposure every day because our asset levels are going down. So you actually end up doing a little bit better than 3 times the index return would be in this case. And that's relatively speaking. I know being down 22.5% is not good. Nobody likes that. But it is better than being down 24%. So both of those examples were compounding when it works in your favor. Like I said, the cheesy line around Direxion is the trend is your friend. Where we get into trouble is a choppy sideways market, and this is where you really need to be focusing on your positions, trading frequently, monitoring them very often. In this example, we see a choppy market where the index is up 2%, it's down 1.9%, up 2% over the 4-day period. The index is flat, so 3 times that is obviously also going to be flat. But we see on the right-hand side that the cumulative fund return was actually a loss of 47 basis points. And this is because of compounding, because we're resetting our portfolio every day, we're increasing our exposure, we're decreasing our exposure, and because we have a 3x leveraged fund, the swings are going to be bigger, and that ends up being a loss in the fund in this type of situation. So let's look at a real-world example here. I'm going to show both a volatile market and then a trending market. This first example is going to deal with our semiconductor products. They're 3x bull and bear semiconductor products based on the Philadelphia Semiconductor Index. These typically tend to be some of our more volatile products. Now, during this time period shown on this slide, from May 28th, 2010 to the end of September of 2010, volatility was very high. It was running around 37%. The index, however, over this period of time was only down slightly. It was down 1.28%. So if we look at the bull fund, the orange line on here, that means we might expect the bull fund to be down 3.84%. In actuality, it was down almost 14%, which is a difference of about 10%. And this is primarily caused due to compounding. Now, if we look at the bear fund, it's actually worse, and I apologize, there's a little bit of a math error in here, but -3 times the index return would actually be 3.84%. The bear fund return was actually down 16% for a difference of almost 20%, primarily due to what we've been talking about, to compounding during this volatile environment. Now, keep in mind, for this example, this is if you had held this position for the entire 3 or 4 month period. There were some opportunities in here, as you can see in the slide. If you had held the position for 2 or 3 days, you could have done really well. But this is just to give an example of why holding during a volatile period of time is probably not the best idea with leveraged or inverse products. So on this slide, we're going to show that trend is your friend again. As you can see here, the index had a big run-up and went up 26.5% during this period of October through January of this year. Volatility was much lower. It was down to about 19%. 3 times that index return is around 79.5%, but the bull fund returned almost 94%. So you get almost an extra 14% due to the compounding in a trending market. And on the downside, on the bear side, -3 times the index return was -79.5%. The bear fund was down only, and I say that as a relative measure, down only 54%. So a difference of 24% that I don't want to use the word gain, but you were better than what 3 times the index would have been because of compounding. So this is where the trend can actually be your friend. So keeping that all in mind, what we want to do now is talk a little bit about some strategies that people have used. Hopefully those slides gave you an idea of how path dependent these funds are, and when they're held over a longer period of time, the performance very much depends on the path. The next several slides we're going to talk about how these funds have been used. As I've mentioned, typically these funds have been designed for traders like yourselves. We see them used as very short-term directional plays, someone looking for a short-term pop in a particular sector. We've also seen them used as portable alpha strategies, and we've also seen them start to be used a little bit more, particularly in the fixed income segment, as hedging tools. So our first example is going to be a directional play, and as I mentioned, the funds were really designed to be trading tools. They're very responsive to catalysts in the market. We often see large upticks in volumes and assets as different trading opportunities present themselves. On this particular side, you can see our energy ETFs, which are ERX and ERY, and how they responded to some geopolitical unrest in North Africa and Japan recently. We see some steep increases in volume on the news of the Egyptian crisis, the start of the Libyan crisis, and then the tsunami in Japan and how they affected oil production. We can see those 3 spikes on this slide right here. Along that same path, there's been, with the uncertainty in oil production and the resulting price increases, that led to some strong performance in natural gas as possible alternative energy sources. Here you can see the uptrend in the notional value of our natural gas-related bull fund. Again, you can see those spikes based on those catalyst events too. So those are just 2 quick examples of how the products are used as short-term directional tools. This slide for portable alpha, we have a situation where somebody's looking for short-term exposure to mid-caps. They have a good feeling about mid-caps, and they've got $100,000 to invest. They could go invest that $100,000 in a 1-beta ETF, or they could decide to put $33,000 into a leveraged ETF. They would still get the desired $100,000 worth of exposure, but they'd have $66,000 worth of capital to put over into possibly another non-correlating asset class or another trading vehicle. And this is actually a way in which a leveraged ETF can be used to mitigate risk. And then finally, some hedging and some defensive plays. It seems like most people are talking about precious metals and anything that has to do with the gold or silver these days, that they seek some protection from inflation or possibly the prospect of a falling dollar. Obviously, gold miners stand to benefit from this, and you can see the very strong correlation in gold miners in this slide that I have up on the board now. We do have some gold miners products. You can see the increase in the shares outstanding in our 2X gold miners product, Nugget, NUGT. This slide is actually a few weeks old, and since then it's continued to grow. I think we have another 150,000 shares that have come into existence since then. Market makers have been creating new shares of Nugget to keep up with the demand in the secondary market, and we think this fund is really poised to take off and grow in the short term. On to everybody's favorite topic these days, the bond bubble. Are we in a bond bubble? When, if it's going to pop? Guys like Bill Gross certainly seem to think so. There have been some tremendous inflows into bond funds over the past 5 years as people have sought the safety of treasuries. And as a result of that, we all know that we've got very low interest rates. And the conventional thinking is really can't get a whole lot lower. They're only going to go up. And it's not a matter of if, but when. And of course, we all know when interest rates go up, bond prices decline. One of our fastest growing funds is TMV. TMV is our 3X bear fund for the 20-plus year Treasury Index. We've seen some huge flows into TMV as investors look to either hedge their portfolio's interest rate exposure or to actually speculate on a rise in interest rates. And finally, with the advent of fixed income ETFs, it's really opened up some fixed income trades that have typically been used by institutions. Curve trades allow you to bet on whether the long-term rates are going to increase faster than short-term rates, which we would call a curve steepener trade, of course, or the opposite, a curve flattener trade, when short-term rates are rising faster than long-term rates. This has been very popular, like I said, among institutions, and now with inverse treasury ETFs, it kind of brings this strategy to individual investors looking to put something like this into their own portfolios. So with all that being said, I know I went through a lot of information here, but the bottom line with leverage and inverse ETFs is you need to monitor them frequently, and we recommend trading them frequently as well. They're not meant to be held and unmonitored for long periods of time. During volatile periods, we want you to know that you need to trade them probably more frequently so you don't have the effects of compounding happen, as we saw in some of those slides. During less volatile periods, you still need to monitor them frequently. You may not need to trade them as often, but you don't want to be on vacation if one of these catalyst events happen and you can't get to a computer to get out of your position. So less volatile periods, still monitor them frequently, but you may not need to trade them quite as often. And finally, if you do not have the resources or the time to learn about these products and to monitor them, then we would probably recommend not trading them. We don't want people to have a bad experience with the products, and they really do take some time to learn how to use and to use effectively. So if you do have the resources and the time, they can be a very powerful tool. But if you don't have the resources, if you don't want to put in the time, we certainly don't want you to have a bad experience with them. If you want to check out DirectionShares.com, we've got a lot of great tools and resources for you to enhance your learning there. We've got a tracking center, a volume tool, a lot of different tools for you to use in your daily trading. I would encourage everybody to take a look at DirectionShares.com for that. I have here a lineup. I know that's a lot of information to view over while you're all looking at this slide here, but you can get this at DirectionShares.com /Lightspeed. And I think with that, that's everything that we wanted to get through in terms of the presentation. I'm happy to take any questions that anybody has at this time.
Okay, thanks, Jordan. I'm just going to give people a few minutes to get their questions together. I think you've done a really great job because I don't see too many questions coming in, but we do have a few. So let's start addressing these.
All right, so the first question that we've got coming out here that I see, might have a couple. Will size of an ETF fund affect performance? some ETF volume is very low. So the size of the fund will not affect the performance. If volume is low, you might not get the best execution. So if there are not enough shares there, you might end up getting buying in at a higher price, or maybe selling out at a lower price than you wanted to. And that goes back to that one of the first, maybe the second question or third question I mentioned at the beginning in the pop quiz, where if you buy at a discount, you may have more exposure, and if you buy at a premium, you may have less exposure for that particular day. So if volume is low, I would take that into consideration. A tip to use if you want to find the fair value of the ETF at any point during the day, you can type in that symbol of the ETF and then follow it with dot or period IV. And that will give you that INAV, the indicative value of the fund at that point. And then you can see if the bid or the ask is way above or below that. Second question, in which sectors do we see the most volatility lately? We've seen a lot of volatility in our gold miners products lately. Typically, the smaller sectors are going to be more volatile. We've also seen some increased volatility in our 20-year Treasury Index, the TMV, the last product that I mentioned in one of the examples. We've seen more volatility in that in the last 180 days than we have before that. Next question was, do we have an e-newsletter? We do have what's called the Exchange, which sends out information about our ETFs. I believe you can access that through our website. I can follow up with whomever that question was with specific instructions on how to get signed up for the Exchange, and that does go out frequently. Do you use leveraged NASDAQ 100 funds? We do not currently have any leveraged NASDAQ 100 funds. I know we have several, or at least one in registration, although we do have to get what's called exemptive relief from the SEC before we can launch a fund. We have not gotten the exemptive relief from that yet, but it is, I would guess, in the hopper. What's the guideline to do reverse splits of our 3x ETFs like FAZ? We don't have hard and fast guidelines for reverse splits. What we aim to do is make sure that these products are very easily tradable for our clients, and we want to provide the best trading experience possible for the fund. Typically, we start looking to do a reverse split if the products start trading under $10 a share. But there aren't any specific rules for that we have in place. It's something that we are monitoring all the time, and we do look at relatively frequently. We also do like to do them in groups where we don't want to do one reverse split, this week and one reverse split in 2 weeks. We'd wait until 4 or 5 are kind of in that range and do it all at once. Can you hold the inverse ETFs in a Roth or a SEP retirement account? I believe you can hold them in Roth and SEP retirement accounts. I need to verify and double check, and I will get back to whomever asked that question. But yes, I believe you can do that. What if I were to trade a large block at the end of the day? What's the best way to execute? There are several ways to do this. We recommend everybody use limit orders when they're trading, of course. Find what the fair value is at the end of the day using the notation I gave you, .iv at the end of the ETF symbol. Volume does typically tend to be less at the end of the day, or it has been. I would try to work into the trade over a longer period of time. If you do, and I'm not sure this is the most appropriate answer for this group, but if you do have access to different liquidity providers, sometimes firms can help get blocks of trades executed for you. That I'm not sure if the type of investor that you are, whomever asked this question, but that is available, and I'm happy to follow up with you afterwards to discuss some of those as well. Mike, I think that was everything I saw come through on the chat.
Yep. Okay. Looks like we have one final question. It's about do you offer any ETFs like iShares Silver?
We do not currently have an iShares, an ETF that's similar to the iShares Silver ETF. We have registered for both silver and gold. We're looking to hopefully have those launched later this year, although again we have to get approval to launch those. But those are two that we really do want to launch. But as of right now, we don't have leveraged gold or silver ETFs.
Okay, perfect. All right, so it looks like that's all the questions. Jordan, thank you for the very thorough presentation and for taking everyone's questions. Certainly a lot of great information there that I hope our guests have found insightful. And more importantly, I hope that the information is utilized to improve their trading.
Thanks, Mike. We really appreciate the opportunity.
Great. As I mentioned before, we will have the recording of this webinar on our website, so our guests can come back within a few days and they'll find it at lightspeed.com/webinar. And if you have any questions directly for Lightspeed, you can always email us at contactus@lightspeed.com. And there's the email address and the phone number right there. So with that, I would just like to thank everyone again for joining us, and I hope that you'll join us for future webinars as well. Have a great afternoon, everyone. Thank you.